Most people think banks are giant money warehouses. You deposit your salary, the bank locks it safely away, and later lends some of that same money to someone else. It sounds logical, it feels responsible, and it is completely wrong. Modern banks do not work like storage vaults. They do not wait patiently for savers before lending. Instead, banks create new money every time they approve a loan. No printing press. No trucks of cash. Just a few numbers typed into a computer system, and suddenly, money that did not exist 5 seconds earlier is now part of the economy. This strange process sits at the center of modern capitalism. It powers economic growth, fuels housing booms, and also triggers financial crises. To understand why banking systems periodically collapse, you must first understand how money is actually created inside a bank. The Great Banking Myth. Ask most people how banks work, and they will tell you a simple story. You deposit money. The bank keeps it safe. Then, it lends part of it to someone else. Your savings fund other people's loans. That story feels intuitive, but it describes a system that barely exists anymore. In reality, when you deposit money, it does not get placed into a pile waiting to be lent out. Your deposit becomes a liability for the bank, money it owes you on demand. Loans work differently. When a bank approves a loan, it does not take money from depositors. It creates brand new money by crediting the borrower's account. This is why modern banking is often misunderstood. Lending does not transfer existing money. Lending creates new money. What fractional reserve banking really means. The phrase fractional reserve banking is widely misused. Many people think it means banks lend out your deposits while keeping only a small fraction in reserve. That description is outdated. Reserves are not your deposits. Reserves are special digital money that commercial banks hold at the central bank. They are used only to settle payments between banks. When money moves from one bank to another, reserves move behind the scenes to balance the system. Your personal deposit never leaves your bank's balance sheet. If you transfer money to another bank, your bank sends reserves to the other bank, not your actual deposit. Historically, banks were required to hold a fixed percentage of reserves relative to deposits. In many countries today, including the United States, this requirement is effectively zero. Banks are no longer mechanically limited by deposit percentages. That is why banks can expand credit far more freely than most people realize. How a loan magically becomes money. Imagine a small bank with $10,000 in deposits. It approves a $1,000 loan to a borrower. The bank does not hand over someone else's saving. It simply types $1,000 into the borrower's account. Instantly, total deposits rise to $11,000. No physical money moved. No one lost savings. New money entered the economy through accounting entries. This is the core engine of modern money creation. Nearly all money in circulation today originates from bank lending, not government printing. Why banks still cannot create unlimited money? If banks can create money by lending, why don't they create infinite money and become infinitely rich? Because the moment borrowers spend their loans, reality pushes back. When borrowers withdraw cash, banks must hand over physical currency. When borrowers transfer money to other banks, reserves must move. If too much money leaves a bank too quickly, it can run short of liquid funds. Even though loans create deposits, spending drains cash and reserves. This creates a natural brake on reckless lending. A bank that expands too aggressively becomes fragile. Liquidity shortages, not accounting entries, are what destroy banks. How banks actually make money. The magic of money creation does not mean banks receive free profits. When a bank issues a loan, it creates a deposit, but it also creates a serious financial risk. The borrower immediately spends the money on a house, a car, or a business, and that money begins leaving the bank through cash withdrawals and transfers to other banks. This reduces the bank's liquid resources. Only gradually, over many years, does the bank earn income as the borrower repays the loan with interest. This is why the bank's real business model is not money creation itself, but the interest margin, the small difference between what it earns on loans and what it pays on deposits and other funding. Banks also invest in government bonds and other low-risk assets to generate steady income while maintaining stability. But when borrowers fail to repay, the illusion of easy money disappears instantly. Loan losses must be covered using the bank's own capital. If defaults pile up across thousands of borrowers at once, even large banks can be pushed to the edge of collapse. Why this system exists at all? If bank-created money carries such danger, why does the world rely on it? Because modern economies cannot function without large-scale credit. Without borrowing, growth would slow to a crawl. Businesses would need decades of savings before expanding factories or hiring workers. Families would need to save for a lifetime before buying homes. Governments would struggle to build highways, hospitals, and energy systems. Credit allows societies to build first and pay later, dramatically accelerating development and innovation. The problem is not credit itself, but excess credit. When lending expands too rapidly, money floods into housing markets, stock markets, and speculation rather than productive investment. Prices rise faster than real economic output. Asset bubbles form. Banks appear highly profitable during the boom, even as they quietly become more fragile. The system grows unstable long before the damage becomes visible. How bank runs still happen? Because banks create money through lending, they operate with a built-in mismatch. Deposits can be withdrawn instantly. Loans are locked in for years. If too many customers demand their money at once, the bank cannot quickly sell long-term loans to raise cash. This is the classic bank run. Even financially healthy banks can collapse if panic spreads faster than liquidity can be raised. That is why governments impose emergency withdrawal limits and sometimes shut banks temporarily during crises. These measures are meant to calm the public, but they often signal that something is wrong, which can intensify fear. History repeatedly shows that once trust in banks cracks, financial systems can unravel with frightening speed. The real limits on modern banks. In today's banking system, the main constraints on lending are no longer reserve ratios. The real limits are capital and liquidity. Capital is the bank's own money, provided by shareholders. It acts as a financial shock absorber when borrowers default. If losses exceed capital, the bank becomes insolvent. Liquidity, meanwhile, determines whether a bank can meet withdrawals and transfers in real time. Even a profitable bank can collapse if it cannot access cash quickly enough. Banks must constantly balance growth against these two constraints. This is why lending standards tighten sharply during financial stress. It is not caution, it is survival. Why banks are still extremely cautious. Despite their ability to create money through lending, banks are not reckless money machines. Every new loan expands risk. Too many bad loans can erase capital. Too many withdrawals can drain liquidity. A bank can look healthy on paper while becoming dangerously fragile beneath the surface. This is why modern banking often appears conservative and slow-moving. Behind the scenes, it is a constant balancing act between expanding credit and preserving stability. The entire system depends on maintaining confidence while managing invisible risks. The hidden engine of the economy. Banks do not simply recycle existing savings, they actively expand and contract the money supply through lending. This invisible process shapes nearly everything in modern life: housing prices, stock market cycles, business investment, and financial crises. When lending expands, economies boom. When lending contracts, recessions follow. Understanding banking is not about vaults and cash drawers. It is about balance sheets, incentives, and trust. This hidden engine quietly drives the rise and fall of entire economies. If you enjoyed this deep dive into how banks really work behind the scenes, make sure to like and subscribe so you don't miss our next breakdown of the hidden systems that shape your life and money. We post smart, clear explanations like this every week, and your support helps the channel grow. Like and subscribe, and I'll see you in the next one.